Let's talk about taxes. We are going to talk about how they're defined, how tax brackets work, and then probably the most misunderstood personal finance topic of all time, marginal and effective taxation. Okay, let's get into it. Taxes at its most fundamental are just an obligation to the government for using its services. So how does it work? Well, you already have an intuitive sense for how this works because you probably heard of tax brackets. And that basically means the taxes you owe personally are based on your income. The percentage of what you owe increases as your income increases. However, this does not mean your entire income is taxed at that higher percentage. So I think this is best illustrated with an example, and we'll walk through one together. So let's say you're single and you make $200,000. You are taxed for the first $9,875 at 10%. For the next $30,000 and on the next $30,000 of income, you're taxed at 12%. And on the next $45,000 of income, you're taxed at 22%. And the next $80,000, you're taxed at 24%. And then for the $40,000 subsequent dollars, you're taxed at 32%. So this is the difference between marginal tax rate and effective tax rate. Marginal tax rate is the percentage of taxation on the last dollar of income. If you were to look online and see at the $200,000 income, you're taxed at 35% or 32%, that is your marginal tax rate. However, this doesn't mean your entire income is taxed at that percentage. It just means that the last few dollars are taxed at that percentage. The effective tax rate is a percentage of taxes on your entire income in aggregate. So although your last dollar may be taxed at 35%, the majority of your income is not. So why is marginal and effective tax rates so important to understand? Understanding effective tax rates allows us to see that there is no cliff at which earning more income means you make less money. Some people have this false idea, but it's actually not a thing. Understanding marginal tax rates means that you see the value of investing your money with pre-tax dollars. And let's look at that further. So this is an example of if you were to use pre-tax dollars with a traditional IRA or 401k to invest in a retirement account. A good way to lower your income for tax purposes is using one of these accounts. So every dollar you contribute to a pre-tax retirement account is a dollar that's normally taxed at the highest tax bracket. So if you contribute $6,000 to a traditional IRA, which is the limit for annual contributions, your highest marginal tax rate is 35%. So you only really pay $2,100 less in taxes. That's your tax savings for having contributed that money to a pre-tax retirement account. So here's the takeaway. Your taxes are a very deep topic, but understanding marginal versus effective taxation is about half the battle, literally. So thanks for sticking with me as we explain this. See you in the next one.